enhanced overall portfolio of performance to 8.5% annualized in the mid and large cap universe, and around 25% with the small caps.
Publicly traded companies release their earnings dates, some 4 times a year, sometimes 2 times a year, and people anticipate those dates, expecting to hear about the economics of the publicly traded company that they may hold in their portfolio. They want to know, is it going to be good news, bad news, neutral news? But the date itself is what the company establishes prior to the actual earnings per share. And those are not really just calendar events. Why? Because companies revise them. Companies set tentative dates or verified dates, or move those around between tentative and verified in any other number of ways. And to that end, what does that mean when they revise those dates before they've even released the finances for that quarter? I understand you, Marko, though you've done a little deeper dive into this. What'd you learn?
Yeah, we tested 2 core earnings date strategies using the earnings dates dataset and another approach that folds in sentiment. In the first core strategy, we tested whether earnings delays may signal weak company performance, while advancing the date may be a sign of good news, which is a claim that several other studies have made. So to do this, we performed event studies around earnings events, which show that advancing or delaying earnings announcements can, in fact, be predictive of positive and negative performance results, respectively. And running a backtest on long-short portfolios based on this signal, we were able to get pretty robust results to the tune of 8% annualized returns for mid and large caps, and around 20% for the small caps. Now, if this assumption that advances or delays in dates is predictive of earnings results is true, then we can also assume that the market should act proportionally to sequential date changes themselves prior to the announcement. And in this second strategy we studied, we showed that there are outsized price reactions around earnings dates changes themselves. So in these 2 core earnings dates-based strategies, we were able to show that they produced alpha on a standalone basis. So if you're a trader looking to leverage this information, what do you need to think about as you attempt to fold this data into your strategy?
That's a good question. The initial response, people would think, well, it must be calendar data. I'll go to their website, I'll find it, I'll mark it down, and I'll keep it. Truth is, you could see these calendar dates all over the web, but I can't trust that. I really do have to go to the company itself, and it may be that they don't put it on their website. Could be through a company-issued press release. It could be through a letter or a memo. You have to get it directly from the company for compliance reasons, but really for the most accuracy that you can get out of that company. Why trust anybody else to tell you when a publicly traded company is going to set their date? Ask the company themselves. So it's really important that you observe the entire life cycle of that company setting the date all the way up to the EPS, and doing it quarter over quarter over quarter, or over first half, second half of the year. And that way you've got the foundation of accurate data, and you're going to meet all the needs of your trading strategy because you're going to feel confident in the accuracy of that data that you've obtained. There's another way to go with this, and that is, now you've done your homework, you've got that data, how could you augment your trading or risk strategy? Well, I understand, Marko, that you took a bigger look at that along with your first 2 parts, looking at the revisions of the data. You added in sentiment or guidance or news. How did that work out?
Yeah, first of all, because earnings are seasonal and coming in waves of quarterly announcements, the signal of the first core strategy can be pretty sparse in between the quarterly releases, whereas the calendar changes happen throughout the year. So what we did was we showed that a blended approach combining the signal of the 2 core strategies can enhance overall performance. Now, if we overlay sentiment on top of that, the performance enhancement is even more pronounced. And we found that the magnitude of price reactions following advance and delay events is the largest when the company is on a positive overall sentiment trend. So a blended strategy that combines the two core earnings date strategies along with the sentiment overlay enhanced overall portfolio of performance to 8.5% annualized in the mid and large cap universe and around 25% with the small caps. For a more comprehensive review of how we implemented these strategies and to see the results in a bit more detail, please reach out to us at RavenPack and we'll send you the full report.